Hello everyone, welcome to the 98th episode of me learning how to trade in Forex. So in the last video we went through the Forex Trader's Guide to Major Economics, basically an introduction to covering different country profiles around the world, all the important ones. So we got the United States of America, we were going through that, and then we got up to until where do we get up to? We get up until here, important economic indicators for the USD. So I remember I made the brief headers for each of these factors or indicators, and in this episode we're going to finish going through them all and then carry on with the other countries. So let's get started. Important economic indicators for the USD. So non-farm employment change, or NFP for short. The NFP employment report measures the change in the number of employed people in the prior month. Right? Okay, so whoa. Okay, so measures the change in the number of employed people in the prior month. GDP, or gross domestic product report, is a measure of the country's total value of all final goods and services. So measures the country's total value of all final goods and services. Retail sales. The headline retail sales report measures the monthly change, measures the monthly change in the total value of sales at a retail level. Change in the total value of sales at a retail level. The core version of the report, on the other hand, excludes vehicle sales. So the core version excludes vehicle sales. Measures the monthly change in the total value of sales at a retail level. Consumer Price Index. The CPI measures the change in the prices of a fixed basket of goods and services. So measures the change in the prices of a fixed basket of goods and services. Measures the change in the prices of a fixed basket of goods and services. The core account excludes food and energy prices because of their volatile nature. So the core account excludes measures the change in the prices of a fixed basket of goods and services. So for example, in that basket, the core account excludes food and energy prices. So you have one set of goods and services in comparison to the next month, and then you can see how much price has changed. Right, okay, I see. So the core account excludes food and energy prices due to their volatile nature. Personal consumption expenditure. This is very similar to the CPI report as it measures the price change of US consumer goods. Similar to CPI, measures the price changes of US consumer goods. The reason why you look at this report is that this is the one that the Feds look at when making decisions regarding monetary policy, and we all want to be in cahoots with the experts, right? So this is the one the Federal Reserves look at when making decisions regarding monetary policy. University of Michigan Consumer Sentiment. Every month the University of Michigan releases its consumer sentiment reports. This index measures the attitude consumers have towards the economy. So, released every month. Measures the attitudes the consumers have towards the economy. The more confident consumers are about economic conditions, the more likely they are to spend. The more confident the consumers are about the economy, economic situations, the more likely they are to spend. Okay, what moves the USD? The gold rush. Whenever the dollar is at risk of losing its value due to inflation, investors turn to gold for safety. Unlike most financial assets, gold maintains its intrinsic value. Gold is gold. It is the same everywhere, so when gold prices are rising, it could be a sign that dollar is losing its appeal. When the dollar is at risk of losing its value due to inflation, investors turn to gold for safety. Therefore, when gold prices rise, it could signal that the dollar is losing value. Economic developments in the US. Fundamentally, positive economic developments in the US attract more participants to invest in the US. An investor would, of course, need to have some dollars to be able to transact in the US. So as the demand for US investments increase, the demand for greenback rises as well. Positive economic situations or economic developments in the US attract more participants to invest in the US. Therefore, as the demand for US investments increase, the value of dollar also increases. Capital inflows and outflows. With respect to Japan and London, the US probably has the deepest and most advanced financial markets. This provides the many kings, sultans, billionaires and heirs around the world with many types of investments that they can choose from. In order to invest in these American assets, investors will first need to convert whatever currency they are holding into the US dollars. The capital inflows and outflows from the US financial markets can have a significant effect on the value of the dollar. Capital inflows and outflows from the US financial markets can have a significant effects on the value of the dollar. Economic developments around the world. Since the USD takes up about the majority of daily currency transactions, just about any major development in the world, i.e. strong GDP growth in Australia, a stock market crash in Beijing, or a Godzilla attack in Tokyo, affects its short-term valuation. Bond yield differentials. With investors always looking for the best deal for their money, it is important to keep track of the differences in the yields of bonds of the US and other foreign countries. If investors see that bond yields are rising in foreign countries while yields in the US are staying steady or going slower, investors will move their funds out of the US bonds, selling their dollars in the process, and begin purchasing foreign bonds. Keep track of the differences in the yields of bonds of the US and other foreign countries. Rumors on the interest rate grapevine. Market participants pay attention to interest rate trends, and you should too. If the Fed is expected to raise interest rates, this means that demand for dollar-denominated financial assets like treasuries could rise, which would be bullish for the dollar. If the Fed is expected to cut interest rates, it could lessen demand for these assets, and we could see the investors move their funds away from the dollar. Since Fed officials usually drop hints about the central bank's future interest rate moves, traders are all ears during policymakers' speeches. Pay attention to interest rate trends. Trading the USD. USD as a base currency. USD/XXX is traded in amounts denominated in USD. Standard lot sizes are 100,000 USD and mini lot sizes are 10,000 USD. The pip value, which is denominated in XXX, is calculated by dividing 1 pip of the USD/XXX, which would be 0.0001 or 0.01 depending on the pair being talked about, by the USD/XXX current rate. Profit and losses are denominated in XXX. For one standard lot position size, so that's 100,000 USD, each pip movement is worth 10 XXX. For one mini lot set position size, each pip movement is worth 1 XXX. For example, if one pip is equal to 0.0001 and the current exchange rate of USD/XXX is 1.4, 1 pip of one standard lot would equate to $14. Margin calculations are based in US dollars, with leverage of 100 to 1. 1,000 USD is needed to trade 100,000 USD CAD. USD as a quote currency. XXX/USD is traded in amounts denominated in XXX. Standard lot sizes are 100,000 XXX and mini lot sizes are 10,000 XXX. The pip value, which is denominated in US dollars, is calculated by dividing 1 pip of the XXX/USD 0.0001 or 0.01 depending on the pair by the XXX/USD's current rate. Profit and loss are denominated in US dollars. For one standard lot position size, each pip movement is worth 10 USD. For one mini lot position size, each pip movement is worth 1 USD. Margin calculations are based in US dollars. For example, if the current XXX/USD rate is 0.89 and the leverage is 100 to 1, 890 US dollars is needed to an available margin to be able to trade on a standard lot of 100,000 XXX. However, as the XXX/USD rate increases, a large available margin in USD is required. Conversely, the lower the XXX/USD rate is, the less required available margin is needed. Right, okay. USD trading tactics. Now let's put all these things we just learned and come up with some trade tactics for the USD. Looking at differences in US economic developments and economic data from other major current economies is a good way to start off trading the USD. So, USD trading tactics. Look at the differences in US economic developments and economic data from other from other major economies. Look at the differences in US economic developments and economic data from other major economies. For example, a jump in the US retail sales and ugly results on UK's employment situation report give you a reason to sell the GBP/USD. The US dollar or USDX. For example, a jump in the US retail sales and ugly results in the UK's employment situation report give you a reason to sell the GBP/USD. So this will give you a reason to sell. Let me just think that through, how that works. So, US retail sales goes up, which means the general population has more confidence in the economy and therefore is willing to spend more, right? So if they're willing to spend more due to their confidence in the economy, that means the economy is doing well. So people are less inclined to save their money instead and rather spend it. So if people are more inclined to spend their money, that means we've done this before. What was the reason? Here we go. I can't find it, but I think it's just basically the economy is good. There we go. The economy is good, so people are willing to spend more money instead of saving it up. That's that. However, for the UK employment situation reports, that's pretty bad, which means there's a lot of unemployment. I know, which means there's not much UK employment around, so therefore lots of people are unemployed. Therefore, economy isn't doing that good right now, right? So if the US economy is doing good, but the UK economy isn't doing good, then that means investors are more likely to put their money in an economy that's doing well. So that means they would rather sell their sell their GBP to buy USD instead. So sell the USD and buy GBP instead. No, sell GBP and buy USD instead. Right? So this means you're trading USD for GBP, but you're selling it. I think the idea is just to gain US dollars rather than the GBP. But why would you sell the GBP/USD though? Because you're selling the opportunity to trade your USD into GBP. So you're selling it because you believe that the value of this USD or GBP/USD is going to fall. So you believe it's going to take less USD to buy 1 GBP. Which is true because USD is going to strengthen against GBP, so it's going to take less USD to buy the same amount, to buy 1 GBP. Because the USD is stronger than the GBP. Okay, that makes sense. Okay. I see. The US dollar index, or USDX, which tracks the performance of the USD versus a fixed basket of currencies, is also a great barometer of the strength of the USD. By regularly looking at the US dollar index, you can find some clues on where the USD is headed. Look at the US dollar index. A USDX that is trending upwards could provide you additional confirmation you would need to take a short position on the EUR US/USD. A USDX that's trending upwards. So that means USD is trending upwards. So if USDX is trending upwards, that means where's the USDX? USDX, where's the USDX? Total. A rise in the USDX will likely result in a rise of a currency pair of USD/USDX can be used as an indicator of the US dollar's strength. USDX and Euro USD inversely correlated. So if USDX is going up, then that means Euro USD should be going down, so therefore you short it, right? Okay, I see. A rise in the USDX will likely result in a fall of a currency pair with XXX/USD, i.e. Euro USD. I guess that's what it means. So, talks of a Fed fund rate hike, which signals the possibility of higher returns on US assets, encourage traders to buy up the USD, while don't get left behind. So, which signals a positive high returns encouraged while don't get left behind. Look at the US. Look at the Federal Reserve's funds rate hike. Look at the possibility of a Federal Reserve's fund rate hike. Signaling the possibilities of higher returns on USD, on US assets, which encourages traders to buy up the USD. Taking note of Fed's monetary policy outlook, which is usually part of the Fed's official speeches, could yield some clues about the direction of USD. Take note of the Federal Reserve's monetary policy outlook. Hawkish remarks could serve as signals to go long on USD JPY, while dovish comments could serve as a reason to short the USD/JPY. Wait, hawkish could signals go long? I thought proponents of higher interest rates to fight inflation. Right, okay. So if there's higher interest rates, then that means foreign investors are more likely to invest in the US. So they're going to be buying up the USDs like crazy, therefore increasing the demand of the USD, so which increases the value of USD. Therefore, you should start buying USD, which is the reason to go long. I guess yeah, whereas dovish decreases the interest rates, which means foreign investors are probably going to leave USD to buy something else, which has high interest rates, therefore decreasing the demand. So reducing the value of the USD, therefore shorting it is the way to go. Boom, I see. Okay, Eurozone. Eurozone. The European Union is a brotherhood of 27 member states which started from a tiny gang of 6 neighbouring states in 1951. By the magical powers of the Treaty of Maastricht, it then grew into a large economic and political bloc, making it the largest economic region in the world. Talk about playing a huge role in international trade and global economic affairs. Among these EU member states, 20 countries adopted the euro as their common currency. These nations comprises the Eurozone, which is also called Euroland. They have fully implemented the policies of the European Monetary Union. Members of this elite club are Austria, Belgium, Croatia, Cyprus, Estonia, Finland, France, Germany, Greece, Ireland, Italy, Latvia, Lithuania, Luxembourg, Malta, the Netherlands, Portugal, Slovakia, Slovenia and Spain. Aside from adopting a common currency, these nations also share the same monetary policy set by their European central banks. Euro area, wikipedia.org, January the 1st, 2023. Eurozone, facts and figures. Member nations: Austria, Belgium, Croatia, Cyprus, Estonia, Finland, France, Germany, Greece, Ireland, Italy, Latvia, Lithuania, Luxembourg, Malta, the Netherlands, Portugal, Slovakia, Slovenia and Spain. Size: 1,691,658 square miles. Population: 349,616,346 people. Density: 323 people per square mile. Head of European Commission: Ursula von der Leyen. Head of European Parliament: David Maria Sassoli. Head of European Council: Donald Tusk. Currency: the euro. Main imports: machinery, vehicles, aircraft, plastics, crude oil, chemicals, textiles, metals. Main exports: machinery, motor vehicles, aircraft, plastics, pharmaceuticals and other chemicals. Antonio Banderas, Penelope Cruz, John Claude, the muscles from Brussels, Van Damme. The muscles from Brussels. Imports partners: China 15.89%, US 11.97%, Russia 11.22%, Norway 6.13%, Switzerland 5.14%. Exports partners: US 19.07%, Russia 8.03%, Switzerland 7.49%, China 6%, Turkey 4.14%. Time zones: GMT, GMT+1, GMT+2. Website: https://europa.eu. Economic overview. The Eurozone, which comprises more than half the nations in the EU, ranks as the largest economy with a GDP of 14.372 trillion in 2023. Being a services-oriented economy, services account for a whopping 70% of its GDP. A services-oriented economy. On top of that, the Eurozone takes pride in being the second most attractive investment market for domestic and international investors. As an economic union, the Eurozone has a standardized system of laws, particularly for trade. The size of their entire economy makes the Eurozone a major player in the international trade arena. Because the individual countries are grouped as one entity, it enables them to facilitate trade easier, mostly with its number one trade partner, the US. This active participation in international trade also has a significant impact on the role of the euro as a reserve currency. This is because countries that transact with the Eurozone need to have a significant amount of reserve currencies in order to reduce exchange rate risk and minimize transaction costs. Monetary and fiscal policy. The European Central Bank acts as the governing body for the monetary policy of the EU, led by the current ECB President Christine Lagarde. The Executive Board also consists of the European Central Bank Vice President and 4 other policy makers. Along with the top guns from the national central banks within the Eurozone, they make up the ECB Governing Council, who votes on monetary policy changes. The main objective of the ECB is to maintain price stability in the entire region. Quite a tall order. To achieve this goal, the Eurozone signed the Maastricht Treaty, which applied a certain set of criteria for the member nations. Here are some of the requirements. The European Central Bank acts as the governing body for the monetary policy of the EU. The ECB, the European Central Bank, Governing Council votes on the monetary policy changes. The main objective of the European Central Bank is to maintain price stability in the entire region. To achieve this goal, the Eurozone signed a master which applied a certain set of criteria. So, the MAA STRICHT treaty applied a certain set of criteria for the member nations. The nation's inflation rate must not exceed the average inflation of the three best performing lowest inflation rates states by more than 1.5%. Lowest inflation rates. Doesn't that mean the country's economy isn't doing that well if there's not much inflation going on about? The long-term interest rates. The nation's long-term interest rates must not exceed the average rates of the three low inflation states by more than 2%. Exchange rates must stay within the range of the exchange rate mechanism for at least a couple of years. Exchange rates must stay within the range of the exchange rate mechanism. What's the exchange rate mechanism, and what's for a couple of years? And what's a couple of years? Nations government deficit must be less than 3% of the GDP. Must be less than 3% of the GDP. If a nation fails to meet these conditions, it is penalized with a hefty fine. Yikes! The ECB ECB also makes use of its minimum bid rate and open market operations as its monetary policy tools. The European Central Bank uses its minimum bid rate and open market operations as its monetary policy tools. The ECB minimum bid rate, or repo rate, is the rate of return the central bank offers to the central banks of its member states. The minimum bid rate, minimum bid rate, the rate of return the central bank, so the European Central Bank, offers to the central banks of its member states. They make use of this rate to control inflation. Use of this rate to control inflation. Open market operations, on the other hand, are used to manage interest rates, control liquidity, and establish a monetary policy stance. Open market used to control or used to manage interest rates, control liquidity, and establish a monetary policy stance. Such operations are conducted through buying or selling of government securities in the market. Conducted through buying and selling of government securities in the market. In order to increase liquidity, the ECB buys securities and pays with euros, which then gets circulated. Conversely, to mop up excess liquidity, the ECB sells securities in exchange for euros. So, European central banks control liquidity by buying and selling securities with euros. Other than making use of these monetary policy tools, the European Central Bank can also opt to intervene in the foreign exchange market to further cap inflation. Well, how can they intervene in the foreign exchange market? Central Bank can also opt to intervene in the FX market to control inflation. To cap inflation, or same thing, to control inflation. Because of this, traders pay close attention to comments from the governing council members, since these could impact the EUR. So pay close attention to the comments from the governing council members, since it could impact the EUR. Okay, I'm going to leave this episode here. So in the next video, we're going to carry on from where we left off in the Eurozone section, which is getting to know the Euro. So thank you all for watching, and I will see you guys in the next video. Peace!